Hello, I'm Ben Jones and you're watching Dukascopy TV. The South African Reserve Bank Governor has stated that if the developed world leaves emerging economies to fend for themselves, it will be detrimental to the global economy. Joining me on the line to discuss the economics of South Africa is Alex Smith from First National Bank. Alex, if we can begin by talking about the recent manufacturing PMI data. It stayed at the same level of 49.9, although many were predicting a slightly higher number. Why do you think things stayed as they are, and is the manufacturing sector still recovering from strikes at all?
Yes, it was a little bit disappointing to see that manufacturing didn't pick up. Remember, 50 is pretty much the key level with PMI, so anything below 50 indicates contraction. Firstly, with regards to striking, we had a lot of striking in the manufacturing sector in the third quarter. This reading that you're referring to is for January, so I don't think there was too much striking that it influenced production in the month. However, if we just look across, we can see that one of the major issues with the manufacturing PMI was very, very high price levels, input price costs, actually the highest since 2009. And I do think that pricing pressure on manufacturers is one of the reasons why the PMI was a little bit disappointing. The other is just that sales orders haven't been coming through. Sales orders were at a one-year low. So I think we're still struggling to get a lot of external demand. Remember, South Africa trades a lot with Europe in particular, especially from a manufacturing perspective. And whilst Europe does appear to be gradually improving, the economy there is still struggling a little bit and still has some way to go, I think, before we'll see demand return to the pre-recession levels.
Now, the biggest story regarding South Africa recently is the rate hike following the emerging market pullback. Some are arguing, though, that the benefits could be quite substantial as developed economies start to see bigger growth, because exports will be far cheaper from countries like South Africa. Do you agree with this, or does South Africa have too many hurdles to overcome?
Yeah, I do agree. South Africa should see some export response to this significantly weaker rand. I think the rand's about 20% weaker now than it was this time last year. So that certainly should have an impact. However, South Africa faces some constraints when it comes to exporting. One of them being electricity supply shortages, which is hampering our ability to produce more. The other is our rail network and port network. And of course, the one that's been highly publicized is the ongoing labor unrest, particularly in the mining sector. So those factors are stopping us from taking full advantage of the weak currency. But notwithstanding those factors, I do expect an improvement in export growth as the year progresses. And of course, the weak rand has the opposite impact on domestic consumption. It tends to dampen import demand. So the combination of those two factors should see South Africa's trade balance improve somewhat as the year continues. But these things do take time to actually come through in full.
And finally, Governor Gill Marcus has recently outlined that it will be a danger to developed economies if emerging markets are left behind by the developed world. What does South Africa and others like it need to do to improve its longer-term economic outlook and to improve investor sentiment?
Yes, so South Africa has been described as one of the fragile 5 emerging market economies, those with high current account deficits and also in many cases significant budget deficits. So what South Africa needs to do, and what it is doing at the moment, is going through an adjustment process, as are many of the other countries like Turkey and Brazil and so on, where we need to control domestic consumption and imports, and we need to stimulate export growth. So a lot needs to be done to reduce the infrastructure bottlenecks and the other constraints on exports that I mentioned earlier, so that we can take advantage of our weaker exchange rate. And to the extent that that doesn't happen, we will probably see the exchange rate weaken further. And also we may see further interest rate hikes come through as another means of making South Africa a more attractive investment destination with higher yields for foreign investors, and as a means of reducing internal demand and therefore imports. And then until that current account deficit and budget deficit have started to narrow somewhat, I think South Africa will remain vulnerable, as will others like it, such as Turkey, India, and Brazil.
Alex, thank you very much for joining me today. That is all we've got time for, but I'll be back tomorrow with another exclusive interview looking at the ECB rate decision. So make sure you click back.